नमस्कार दोस्तों. Hello everyone, this is ACCA Amit Kumar and we'll discuss India's 36 impairment of assets. So I've been discussing classification of assets. I discussed about PP, intangible assets, and today we'll discuss about impairment of assets. Now, which standards we apply impairment? The standards which do not use fair value model, fair value measurement basis. So we are using cost model for measuring them. If you are using cost model, we may be required to test for impairment. Now we will not test for impairment annually for each of the asset we are owning, but we'll definitely test them for impairment when there are indicators of impairment. Now how do we get to know those indicators? They may be external indicators, they may be internal indicators. Now if those indicators indicate that our asset may be materially different from what it has been recorded, so we should test for impairment. And when we test for impairment, it may happen that the recoverable amount of the asset may be much more than the carrying amount of that asset. What to do in that situation? So that is an optimistic sign that we are holding an asset at a reasonable amount and we are expecting to earn much more than what is recorded in the financial statements. So we can continue to record it at the carrying amount and we do nothing about it. There is no impairment. But these indications wanted us to test for impairment, and we get to know that the carrying amount is lower than the recoverable amount. What indication does it give to the world? That your financial statements are misleading, the information provided by them is not accurate, because what you are going to earn is less than what you have recorded. What you are expecting to earn through recoverable amount, through testing of impairment, we got to know that we are not going to earn what we have stated in our financial statements. So we should restate the figure and should bring it down to the impaired value. Now depending on which model we are using, where we need to use these impairment of assets. Now if we have a carrying amount in our books, carrying amount of 500,000, what indication does it give to the world? What does this 500,000 represent to anyone? Does it mean that we are going to earn income equivalent to 500,000? Does it mean that we are going to receive economic benefits worth 500,000? And what if we sell it? Will we get exactly 500,000 from selling it in the market? What is the net realizable value? Now when you look at the asset figure or any such figure in the balance sheet, the impairment of assets is only applicable to the assets which are measured at cost model or at amortized cost. Assets which are measured at cost models, or for financial instruments there is a separate model but which talks about amortized cost. So if they are at amortized cost or cost model, we need to test them for impairment. Now what is the reason for doing so? Why we need to test them for impairment? What is the reason behind it? Why we need to test these assets for impairment? Because their carrying amount may be materially different from what we can recover from the use of this asset or sell it. So the next question is, how do we recover the value of an asset? If the carrying amount of an asset is 500,000, how do we recover the value of an asset? How much we are going to get out of it? Will we get 500,000 exactly? Will we get more? Will we get less? So what are the ways of recovering the value of an asset? What do you think? How you can recover the value of an asset? Either by using it, use it, or sell it. There are only two ways of recovering the value of an asset. Either you use it, you receive cash flows from the use of the asset and you expect these cash flows, you discount all the cash flows to present value today, and if there is any outflow to generate these benefits, that is also taken into account. So we can make out what we are going to get by using this asset. We can make out the net present value of all the cash flows, and this is known as value in use. Now we are arriving at this value in today's terms, value in use in today's terms, expecting the cash flow we're going to receive over a period of time, discounting them to present value today. If there are any outflow, we deduct that outflow also, and we get the net inflow in terms of value in use. That if we use this asset, what is the value we are going to get by using this asset? Because we may be getting 1 lakh after 1 year, 1 lakh after 2 years, 1 lakh after 3 years. This is the way we may be getting cash flows, or we may be getting 2 lakhs or 3 lakhs. We may be getting cash flows much more than the carrying amount. If the signs are optimistic, that if we are going to receive much more than the carrying amount, then that's a positive sign. That's the expectation, that we bought an asset and we are going to generate economic benefits much more than the value carried in the books. And the extra benefit we earn over and above the carrying amount in the books is the profit. That's what we are here for. We are here for doing business. And when we are planning to do business, we wish to earn much more than the carrying amount of the assets we have recorded in the books. We wish to earn much more than. We consume these assets into the business. When we consume these assets in the business, the cost incurred on bringing these assets to their present location and condition for them to be ready for use, we have spent money on them. Now this 500,000 which we have spent, we recover by using them, by producing goods or by providing services, and then we charge this amount also in the profit or loss by a medium known as depreciation, or if we are using intangible assets, we are using a medium known as amortization. We spread this cost to the P&L. Our expectation is to earn much more than the value recorded in the asset side. Whatever assets we have recorded, we believe that we are going to earn much more than the value assigned to these assets. And that extra earning which we get from the use or consumption of these assets is the revenue we generate by use of these assets, and we become profitable. Now if there is any doubt on the recoverability of these assets, that you are not going to recover what you are holding in your balance sheet, definitely it is going to lead us to losses in future. So we should be aware of this fact that this asset is going to give us losses in future. If we count all the cash flows projected from the use of this asset, we are going to get, say, 5,60,000. And if you sell it, the same asset is going to give you, what is the other way of recovering the value of an asset? There are only two ways of recovering the value of an asset. One is by using it, one is by selling it. There is no other way we can recover the value of an asset which we are owning or holding. The other way is to sell it. If you sell it, you may not get exactly 5 lakh, and that is, you sell it, you will be able to sell it only at fair value less cost to sell. Fair value less cost to sell. Suppose you are going to get 4,80,000. What to do now? What we should do? We should sell this asset or we should continue to use this asset? What do you think? What if the value of use is that if you use it, you are going to get 460. If you sell it, you get 480. What to do in these scenarios? Two situations of using. The carrying amount in the books is 500,000. In one scenario, the value in use is 5,60,000. In one scenario, the value in use is 4,60,000. When it is 5,60,000, we do nothing, because we are expecting to earn much more than the carrying amount of that asset. We'll do nothing. There is no impairment. But what if the value is 4,60,000 and if we sell it, we'll get 480? What will you do? I'm marking this in This is the situation in orange. What will you do? This is the situation now. What will you do? These are the two values. If you use it, you will get 4,60,000. If you sell it, you will get 4,80,000. What are you going to do? So business takes sensible decisions. Business doesn't take emotional decisions. Whatever is good for the business is being done by the business. So what is good for the business? Selling this asset or using this asset? What is good for the business? If you use it over a period of time, the expected cash flows, discounting them to present value, in today's terms, we get 4,60,000. In today's terms, if we sell it, we get 480,000. What to do? What to do? It's better to sell it. It's better to. It makes sense to sell it for 4,80,000 if the value in use is 4,60,000. We do nothing if the recoverable amount is higher than carrying amount. 5,60,000 is higher than carrying amount of 5 lakh, so we do nothing. So it makes sense to sell it for 4,80,000 if the recoverability is higher than use in the second scenario. So what is recoverable amount? What we are trying to see. What is recoverable amount? What gives us more money? What is the sensible decision? What is recoverable amount? Recoverable amount is higher of value in use and favorably less cost to sell. Recoverable amount is higher of value in use and favorably less cost to sell. Why? Because whatever gives us more benefit, we are going to do that. If selling it gives you 4,80,000 and using it gives you 4,60,000, what are you going to do? So definitely recoverable amount is higher of the two. So recoverable amount in this scenario is 4,80,000. Recoverable amount is always higher of value in use and favorably less cost to sell, because business always takes sensible decisions. Whatever gives us more value, we're going to go ahead doing that. We may sell it for 480, may buy a new machine which is going to give us more economic benefits in the time to come. So we will not be emotional, will not get attached to that asset that will not sell it. We will sell it because that gives us more recoverable amount in comparison to the carrying amount. So if recoverable amount is 4,80,000, if carrying amount is 5 lakh, the asset has impaired. There is an impairment loss of 20,000 which will be charged to profit or loss account. In future there may be reversal of impairment which can happen to the extent of cost. What do I mean by this? Which can happen to the extent of cost. It means that the carrying amount can be restated to the extent of cost by comparing it with the value, with the assumption that what would have been the value, what would have been the value of asset had it not been impaired, which will be able to get the value and cost model, that what would have been the value had it not been impaired. We will be able to get to know the cost model value, because if the reversal of impairment results in recording a value higher than what would have been the value under cost model, we are indicating that we are changing the model. We're changing the model to revaluation model. If you change the value from cost model, if you change the value from cost model and record it at a higher value, it means that you are deciding to move to revaluation model. So is the reason you will encounter this term in Ind AS, that if there is any reversal, that reversal is only possible to the extent of cost. Same is the case for write down of inventories. Even in case of write down of inventories, it can come back to the extent of cost. So this word you will encounter again and again, that it can reverse to the extent of cost. The reason being, we cannot record these inventories, we cannot record these assets at cost model beyond the cost. Because if we record them beyond the cost, we are actually changing the model. So if an entity is using revaluation model, then the model itself is capable of applying the impairment loss. So if an entity is using revaluation model, means the model itself is capable of applying the impairment loss, means that so we do not need to apply, especially Ind AS 36 impairment of assets. Revaluation model automatically takes care of that. If there is a fall in value, of the asset, it is either charged to P&L, profit or loss, or deducted from revaluation reserve if available. So if there is a revaluation reserve available, and if there is any fall in the value of an asset, will not charge everything to P&L. The model itself says that if we have a reserve relating to that asset, we'll first charge to reserve. Any excess we can charge it to P&L. And if there is an increase in value of asset is also taken into account. Increase in value of assets is also taken into account by creating revaluation surplus. Increasing value of assets is also taken into account by creating revaluation surplus. Means that if we are moving from cost to up, as I said, that if the value is 5,60,000, we do nothing because our asset was at cost model. And if it was at cost model, even if there is an expectation of increase in value in use, we are expecting to recover more value in the time to come, we do nothing because there is no impairment. And this is conservative approach of Ind AS, that if there are expected profits, wait for them to happen. If there are losses, we recognize immediately. What is the logic behind it? With profits, we are conservative in approach. With losses, we recognize immediately. So if you're expecting more earning in the time to come, we do nothing. This is we are at cost model, but if we are at revolution model, then the model itself is capable of taking care of the increase or decrease in the value of an asset. If you are using cost model and if there is any fall in value, we charge impairment immediately. That losses we recognize immediately. And if there is any reversal in future, the reversal is only possible to the extent of cost. Why to the extent of cost? Because if you try to record an amount beyond the value of an asset, we are indicating that we are changing the model. Apart from this, if the assets are measured at fair value less cost to sell, assets are measured at fair value through P&L, if they are measured at fair value model, though in India we do not have any fair value model, but IAS 40 does have a model known as fair value model. There is one more, that is fair value through OCI. On this, impairment is applicable, but IFRS 9 only for debt instrument, fair value through OCI, debt instrument. Equity instrument, there is no impairment because they are measured at fair value or directly dealt with in equity. Fair value through OCI, if there is a debt instrument, there can be a doubt on recoverability of cash flows, since they are solely payment of principal interest, and contractually agreed cash flows, and may intend to sell. The change in fair value for this debt instrument is measured at fair value through OCI. The change in this debt instrument is measured at fair value through OCI, and if there is any change in value, this may be, if there is any impairment related to this debt instrument, then the impairment loss relating to it is charged to P&L. So this is not covered under this standard, though, because there is a separate standard for dealing with specially financial instruments and their impairment. There is an expected credit loss model for Ind AS 109 financial instruments, though not covered under Ind AS 36. But I was going to make a statement that anything measured at fair value is required to be remeasured. So I was going to make a statement that anything, so to make it right, to make it valid, I had to say that there is an item in fair value through OCI measurement which is a debt instrument which may be subject to impairment. Otherwise, anything being measured at fair value less cost to sell, fair value through P&L is not subject to impairment because it is being remeasured on each reporting date. So this is also being remeasured on each reporting date, so we do not have to wait for indications of impairment. So we are definitely indirectly testing for impairment, but this, if there is any doubt on recoverability, then this entire change will not go to OCI. Some of the portion may go to P&L if there are indications of impairment, if there is any doubt on recoverability of this asset. So this one clause we need to remember, that when I make this statement to remember Ind AS or IFRS, I make a statement and give an insight that anything measured at fair value, it is required to be remeasured on each reporting date. Anything measured fair value means if there is an asset which is recorded at fair value less cost to sell, like any asset recognized as non-current asset held for sale, though we have made our intention clear that we are not going to use it anymore. Since we are not going to use it anymore, Ind AS 36 impairment of assets is no more applicable, because impairment of assets is comparing recoverable amount. Recoverable amount wants us to see whether we are using it or selling it, whichever gives us more value. When we have declared that we are no more going to use it anymore, when we are not going to use it, then we are left with only sell it option. When we are left with only sell it option, that gives us fair value less cost to sell. And Ind AS 105 non-current asset held for sale wants us to measure it at now fair value less cost to sell. So Ind AS 36 impairment of assets is no more applicable to it, because standard Ind AS 105 is itself capable of measuring it. So my statement, anything measured at fair value is required to be remeasured on each reporting date. So this asset will be remeasured on each reporting date at fair value less cost to sell. Any difference will be taken care of. If it is materially different from the value recorded in the financial statements, it will be taken care of, and the difference will be taken to profit or loss account. This will be measured on profit or loss account. The difference taken to P&L. If it is measured at fair value through P&L, then also the difference is taken to P&L. These are items mainly which are held for trading. Now if the intention is held for trading, then again we do not intend to use them. The use it rules gets ruled out. If we are holding them for trading, use it is ruled out. The only way which is left to recover the value is to sell it. So impairment of assets is not needed, because we plan to recover the value by selling it. So if there is any change in the value, if there is any change in value from the beginning of the year to the end of the year within 1 year, that difference is also taken to P&L. Then as I said, in India, Ind AS 40 only uses cost model, and there is no model known as fair value model, because this fair value model was applicable only to IAS 40. This was specially for investment properties. This model is specially for investment properties, not used in India though, but for your knowledge I am sharing that ISB gives a fair value model, and these investment properties, land and building, which are held at fair value model, are also required to be remeasured on each reporting date, and the difference is taken to P&L. If anything is measured at fair value through OCI, now this was equity instrument. There may be equity instruments designated at fair value through OCI. That is also possible. There is a possibility that there are equity instruments designated at fair value through OCI. Equity instruments, your investments, if they are designated at fair value through OCI, then the only way is the difference is taken to, in these cases, the difference taken to OCI. But they are also remeasured on each reporting date. So you can make out from these statements that impairment is standing opposite of fair value measurement. Though there is nothing such written by any standard or any guidance, it's just my statement through my insights, through my experience, to summarize or to help you to learn, so that you can make out that where is impairment needed. Impairment is needed where an asset is being measured at cost models or at amortized cost, or if it is being consumed. If it is being consumed, the standards applicable are Ind AS 16 PP. If it is being consumed, the standard applicable is Ind AS 38 intangible assets. Other than them, the intention is not consumption. Other than them, Ind AS 40 does use cost model, so the asset may be subject to impairment. Ind AS 40 in India investment property uses only one model, cost model, so Ind AS 36 impairment of assets is applicable to it. Other than them, inventories do not require this standard. Why inventories do not require this standard? Ind AS 2 inventories do not require this standard. Why? Because we measure it at lower of cost or NRV. I call it indirect impairment mechanism, that we do not need to compare the carrying amount with the recoverable amount, because we cannot compare it with recoverable amount, because there is no recovery by use of that asset. The only way is to sell it. So we are directly comparing cost with NRV. Indirect inbuilt impairment system available in Ind AS 2, so Ind AS 36 not applicable. Ind AS 36 impairment of assets is not applicable. Same is the case with Ind AS 105 non-current asset held for sale. Ind AS 105 non-current assets held for sale, because if you get to know where it is going to be applied, when it is needed, I think that gives more clarity that where do we need to use this impairment of asset standard. Non-current asset held for sale, On the date of classification, we compare carrying amount on existing measurement basis, with fair value less cost to sell. So we are comparing. Now this is again, the standard itself is capable of testing it for impairment before classification is held for sale. It is being tested before classification is held for sale. On the date of classification, we are testing it for impairment, indirect mechanism. So Ind AS 105 also doesn't need the standard Ind AS 36 impairment of assets, because Ind AS 105 non-current asset held for sale has its own mechanism of testing for impairment on the date of classification. So once this is done, whichever is the lower of the two gets recognized as non-current assets held for sale. Lower of the two gets recognized as non-current assets held for sale. Subsequent measurement is at fair value less cost to sell. Subsequent measurement is at fair value less cost to sell. The subsequent measurement is fair value less cost to sell. Since we are not using it, the only way now it is being tested for impairment annually. It's indirectly being tested for impairment. So we do not use the term impairment that we are testing for impairment. We are simply watching the value on each reporting date, measuring it at fair value less cost to sell, which automatically compares the carrying amount with the reality of this asset. So this date may come in the middle, that we may have classified this asset in the middle of the year. The reporting date may come in the middle before this gets sold. So this may happen that we may have to remeasure it on the reporting date, and which is done, a subsequent measurement is done at fair value less cost to sell. So no requirement of Ind AS 36 impairment of assets, because standard itself is capable of measuring it. This is another standard known as Ind AS 41 agriculture. In Ind AS 41 agriculture, there is no need of this standard impairment, because the biological assets and agriculture produce at the point of harvest is being measured at fair value less cost to sell. There is only one way of measuring it. There is no use, even in the standard agriculture, there is no use of that asset. Yes, if there is a bearer plant and if there is any doubt on the recoverability of this asset, or if there is anything such, if it is being measured at cost model, then it may be subject to impairment. If it is being used by Ind AS 16 PP, if there is a bearer plant Ind AS 16 PP using cost model, then definitely impairment of assets may be applicable. But if it is using fair value less cost to sell, then there is no need, because we are remeasuring it on each reporting date at fair value less cost to sell. Automatically the values are being taken care of. Then there were three assets which were tested for impairment annually regardless of indicators of impairment. Among the intangible assets, which were intangible assets with indefinite life, intangible assets not yet available for use, not yet available for use, and goodwill. These are three assets in the intangibles category which are tested for impairment which are tested for impairment annually regardless of indicators of impairment. Now, when there are indicators of impairment, only when we test for impairment. If there are no indicators of impairment, we do not need to test for impairment. But these are three assets which are tested for impairment annually regardless of indicators of impairment. In the intangible assets category, which are tested for impairment annually, means that why they are being tested for impairment annually? This is not being amortized. Intangible assets are not being amortized. Goodwill is not being amortized. So if they are not being amortized, then we need to at least check their carrying amount. Is it at the right value, material value, which we are going to recover from the consumption of these assets or from the use of these assets? They are forming part of our balance sheet. Goodwill is purchased goodwill which comes into the books for the first time. Earlier it was used to be amortized, but purchased goodwill doesn't get amortized. They tested for impairment annually regardless of indicators of impairment. Now among them there is one more category, that is CGU, cash generating unit. We may have to test. These were individual assets which we were talking about testing for impairment. There may be CGU which may be required to test for impairment. CGU is the smallest identifiable group of assets, smallest identifiable group of assets which contains which together are capable of generating cash flows. So in case of a CGU, we cannot specifically impair a CGU because we need to test the recoverability of these CGUs together. So we try to know the recoverable amount of these CGUs and compare the value with the carrying amount of the CGUs. Now these CGUs, these CGUs may be allocated goodwill when an entity entered into a business combination, and purchased goodwill. So the CGUs, if they benefit from synergies of business combination, each such CGU is also allocated goodwill. So if the goodwill so calculated is say 60,000, and if we have 5 cash generating units, each benefiting from the synergies of business combination, then the goodwill allocated to each CGU will be 12,000. So the impairment of CGUs, you can read it carefully. So impairment of CGUs is dependent on whether CGU is with goodwill or without goodwill. Impairment of CGU is calculated on the basis of CGU with goodwill, CGU without goodwill. So the hierarchy of impairment is if within CGU the entity can clearly identify the specific asset which is impaired, then charge impairment related to it first. Second, eliminate goodwill to the extent possible. Third, on pro rata basis to all the remaining assets allocate impairment loss. CGU without goodwill, then the hierarchy of impairment in that scenario will be there is no goodwill now. So if you know specifically any asset which is specifically impaired, we can charge impairment to that particular asset. Otherwise, we'll allocate it on pro rata basis to all other remaining assets. So how it is done? Suppose there is a CGU which has goodwill allocated of 12,000, asset 1, asset 2, and there are four assets. If calculate the value 35, 40, 45,000 and 50,000. The total value of the asset is 1,80,000. 82,000 is the carrying amount of this asset. This is the carrying amount of the CGU. The recoverable amount of the CGU is 182 minus, say 60,000 is the loss, and impairment loss of 60,000 we need to allocate it to all the CGUs. So if we know any asset which is specifically impaired, suppose we know that asset 1 was specifically impaired by 5,000, so I can charge, or 10,000, we can charge 10,000 to this asset first. Then we'll eliminate goodwill to the extent possible. So we'll eliminate goodwill to the extent in full. So we have been successful. Say this was specific impairment was 8,000 and 12,000 is charged to the extent possible. Now we are left with 40,000 goodwill, 40,000 impairment loss to be allocated to these three assets. So total of these three assets is equal to 135. So 40 divided by 135 into 40,000 is the impairment loss charged to this asset. Forty-five divided by 135 into 40,000 is charged to this asset. And 50 divided by 135 into 40,000 is charged to the third asset. So recoverable amount after charging impairment loss to these assets is 27,000, 28,148, 33,1,667. The total of these turns out to be 122,000. So this is how we'll be allocating impairment in case we have goodwill available with us. Second example is directly a CGU without any goodwill. If CGU without any goodwill, so there is no goodwill allocated to these assets, and total value of these assets may be equivalent to 36, 42,000, 48,000, 52,000. Total value of these assets is say 178,000. These are the carrying amounts of, these were the carrying amounts. Recoverable amount is say 1,20,000 of this CGU. So total loss turns out to be 178 minus 120. 58,000 is the total loss. Then the only option left now, in this case I assume we did not get to know like which asset is specifically impaired and there is no goodwill assigned to it. The only option left with us is that this will be measured on pro rata basis. So if we total up the impairment loss, we get to know that 36 divided by 178, that's the fraction which we'll use to charge an impairment loss of 58,000. There's an impairment loss of 11730 to be charged to this asset. 42 divided by 178 into 58,000 is the loss for the second instance. Third, it is minus 48 divided by 178 into 58,000 minus 52,000, 52 divided by 178 into 58,000. So total loss so allocated to all the assets on pro rata basis is equal to 58,000, and the recoverable amount of this asset is equal to 120,000 is the recoverability. So this is how we'll deal with CGUs with, this is how the impairment of CGUs is done. Now, another thing which is important is if there is a CGU, with goodwill, then these CGUs are also tested for impairment annually, regardless of indicators of impairment. Now we noticed that there were three such assets which were tested for impairment annually, regardless of indicators of impairment, that were intangible assets with indefinite life, intangible assets not yet available for use, intangible assets purchased goodwill. Now these intangible assets not yet available for use are the ones in this list. There is a CGU with goodwill also gets added. If there is a CGU with goodwill, that also gets added in the list. CGU with goodwill is also tested for impairment annually, regardless of indicators of impairment. Normally we will not touch them, but we will test them for impairment annually, regardless of indicators of impairment. Normally CGU with goodwill, if there is an impairment, that impairment is first charged to goodwill, because we will not be able to, so we may not be able to identify which assets are particularly tested for impairment. So normally the hierarchy is practically, mostly you will see the hierarchy which you will observe, the hierarchy mostly used with CGUs with goodwill is first eliminate goodwill to the extent possible. That's what. So if we talk from exam point of view, our exam may not be testing us, some of the examinations may not test us to that level of specific asset. So if someone is trying to read this content directly for CGU impairment, they may encounter that it is first eliminated to goodwill to the extent possible, and second, remaining assets on pro rata basis. That's the normal impairment of CGU which happens, remaining assets on pro rata basis. So that specific asset one encounters in special circumstances, maybe that they are able to know the machine got damaged, or we know it caught fire, we know that specific asset is damaged, so we can charge specifically to that particular asset which is within that CGU if we are able to do so. If we know the recoverable amount of that particular asset, particularly if we know the recoverable amount of that particular asset, we may charge impairment to that particular asset separately and to other assets on pro rata basis, depending on what is the total impairment loss of that CGU, if that is possible. So the idea behind impairment is clear, that why we are charging impairment. I discussed this in the previous section as well, that now when there is an impairment, there was a lot of stress on this point, that when we are calculating goodwill, the valuation of goodwill has a lot to do with the valuation of NCI. Why there was a lot of stress on this valuation of NCI concept? This has a lot to do with the impairment. Otherwise there is no much of a difference, but we stress a lot on this point that valuation of NCI determines valuation of goodwill, because when we value NCI on proportionate share of net assets, the goodwill so calculated is belonging to parent only. But when we value non-controlling interest on fair value basis, the goodwill so calculated is belonging to parent plus NCI. The reason being that when there is any impairment in goodwill, because impairment of goodwill is tested for impairment annually regardless of indicators of impairment, it may happen that goodwill doesn't impair. But if it impairs, this has a lot to do with the subsequent accounting. Now, if there is any impairment in this scenario, what happens? If NCI is valued on fair value basis, and if NCI is valued on NCI measured on fair value basis. The goodwill so calculated is belonging to NCI measured on fair value basis. Goodwill so calculated is belonging to parent plus NCI. NCI measured on proportionate basis. Goodwill is belonging to parent only. Which means that if there is goodwill impairment, in case of NCI measured on fair value basis, if there is any goodwill impairment, we'll be charging that impairment to group retained earnings, debit, NCI, non-controlling interest, debit, and credit. In both the scenarios will be goodwill, that there is an impairment in goodwill. If goodwill is belonging to parent plus NCI. But if NCI is measured on proportionate basis, then NCI doesn't have a share on it. The entire goodwill is belonging to parent only. If there is any goodwill impairment, the entire goodwill is belonging to parent only. Group retained earnings, debit, and there is no NCI, the entire amount will be, suppose if there is an impairment of 40,000 and NCI has a share of 80%, so 80% of 40,000 will be charged to parent and NCI has a share of say 20%, sorry not 80, 20%, and 20% of it will be charged to NCI and 40,000 goodwill will be allocated. In the second scenario, the entire goodwill impairment will be charged to parents' earnings only. 40,000 is charged to parents' earnings. So is the reason the valuation of NCI has a lot to do with the valuation of goodwill, because it has a direct relationship with the impairment later on, that if goodwill is impaired, how we are going to charge that impairment loss in future. So the main thing in case of impairment is that, if I summarize, the main thing in case of impairment is that impairment testing means that when we compare the carrying amount with the recoverable amount, this concept is known as impairment testing. Impairment testing is when we compare, when this comparison of carrying amount compare carrying amount with recoverable amount, this is known as impairment testing. When we are required to compare the carrying amount with the recoverable amount, we are actually getting into impairment testing, and whichever is, if carrying amount is higher than recoverable amount, then the asset has got impaired. If carrying amount is lower than the recoverable amount, we do nothing. And as I said, these are the instances where impairment is not required, wherein we are measuring an asset at fair value less cost to sell, fair value through P&L. Though in Ind AS 40 we don't use it, but just for your knowledge and information, IAS 40 uses fair value model where we cease depreciation, we are taking the reference to P&L, remeasuring on each reporting date. Fair value through OCI, if it is debt instrument, it may be subject to impairment if there is any doubt on recoverability of it. And fair value through OCI equity instruments are directly taken to P&L. If anything is being measured at fair value through P&L, through OCI, less cost to sell, then they are required to be remeasured on each reporting date. So we'll not wait for them to test for impairment, because there is no impairment testing specially required. They are automatically covered under the standards. And for other assets, we need to test for impairment when there are indicators of impairment. There may be internal indicators of impairment, there may be external indicators of impairment, and then there were 3 instances where we were required to test for impairment annually regardless of indicators of impairment. They were intangible assets with indefinite life, intangible assets not yet available for use. They are in the development phase assets which have met all the criteria of development phase. Any expenditure incurred in development phase is being capitalized. They are also not subject to amortization. Since they are not subject to amortization, the only way out is to test them for impairment annually regardless of indicators of impairment. Purchase goodwill is tested for impairment annually regardless of indicators of impairment. Apart from them, if there is a CGU with goodwill, that is also tested for impairment annually regardless of indicators of impairment. So this is all regarding India's statistics impairment of assets. I thought to give you a brief insight regarding this so that when we discuss this standard in detail with proper detailed indicators of impairment, the testing and the disclosure requirements of this standard, where it is applicable through the course on Unacademy, which you can subscribe using the code ACCA Amit. You can also subscribe to our channel on Unacademy. We, all the educators, are coming together on Unacademy and teaching CA final students so that they can clear these papers with ease. So do not forget to subscribe the channel on Unacademy. Do not forget to follow me on Unacademy and subscribe the course which I am providing on financial reporting new syllabus based on Ind AS, and use the code ACCA Amit to subscribe the courses on Unacademy. So to subscribe any course on Unacademy, you can use the code ACCA Amit to get instant discount. So this is all for the day. Thanks for your valuable time. See you again on Friday, and I'm meeting every day on Unacademy 9 to 11. I'm available with my courses. You can subscribe to them. Thank you so much.